Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is June 19th. Happy Juneteenth to everyone out there, especially in the US where markets are closed and some of you may be having a day off work. We are sitting here towards the end of another eventful week. We are going to bring you discussions about geopolitics, about what it means for portfolios, about markets. But I'm delighted to be welcomed by a guest this week, a friend of mine, fellow podcaster, fellow market guru, Robert Morier. Welcome, Robert. Welcome to the podcast.
Ethan, thank you so much for having me. I'm really looking forward to speaking with you again and taking into account everything that happened this week. It was quite a busy week across the board, so I'm really looking forward to talking to you about it.
Great. Well, just for our listeners, and I will bring up your bio when I start to share the slides, but you are a professor at Drexel University. You're focused on venture capital entrepreneurship. Can you tell us just another minute about yourself?
Yes, thank you. Yes, I teach at Drexel University, so I teach their venture capital concentration, which means that we look at early stage companies, both in the Drexel University ecosystem and outside, and we teach the students how to do due diligence on those companies. And then ultimately, they have the ability to be able to write checks, real life checks into these companies. So hopefully, we can help accelerate their growth. In addition to what I do at Drexel, as you mentioned. I host the Dakota Live podcast. That's a podcast that essentially interviews allocators, asset allocators globally, but primarily in the North American markets across channels. So endowments, foundations, public pension plans, family offices. And we really try to talk with those investors and allocators as to where they're deploying their capital, and more importantly, how they deploy that capital. And then finally, I do work as an advisor as well. I work with a hedge fund, an outsourced CIO provider, a few venture capital funds, but just for some kind of basic, advice here and there. Nothing too serious. I left the industry about 3 years ago. I'm happily teaching, as I mentioned before, at Drexel, and I am in Philadelphia. It is June 19th. It is Juneteenth. I was off today, so I was very happy about that. But I'm also very happy because we have a lot of Europe and global soccer clubs here in Philadelphia this week. So something that's going on is the World Cup of Clubs. So some positive news, all the noise that's going on. I'm happy to say that Manchester United is playing down the street. Chelsea is playing tomorrow. So there is some positivity in Philadelphia.
Absolutely fantastic. Well, a happy hour indeed. Well, let me kick off then and you share the slides as we usually do. Great. Well, it's certainly hot in my part of the world and probably hot in your part of the world. And it seems to be getting hotter from a geopolitical standpoint too. So I've called this week's podcast The Heat is On in many more ways than one. This is Robert's bio, and those of you watching on YouTube can have a great chance to read through that now. Not only is he, the main things he mentioned, he has sold himself short on his lifeguarding skills. So in a week where we all at times it seems fraught with danger, it's nice to know we are in a safe pair of hands here. As usual, we cycle through inflation, interest rates, geopolitics, equity markets, and other asset classes. And in particular, we're going to start this week with the big story, which is, of course, the showdown in the Middle East, the moving from what was, for some measures, described by Ian Bremmer as a phony war that was simmering between Iran and Israel, clearly has now moved into the kinetic phase. It's been very closely watched by many sides here, and so far markets are not as moved as we might expect. We're seeing an effect on the oil price, but a lot of uncertainty injected into that situation. Then we know the Fed has dug into its position on rates. We've got some stability there. Of course, getting back to the Middle East, we can't take our eyes off oil and where that goes from here. We've got even more occurring on the AI side. AI continues to dominate headlines. And then, of course, we'll talk about portfolio implications. So before we get stuck into some of the weeds here, Robert, so you have spent time in the Middle East, you've studied the Middle East. Tell us a little bit about this conflict in terms of where it rates for you in terms of, I suppose, something that could be very disruptive and get more serious from here.
Yeah, thank you so much. And that's right. I did spend quite a bit of my career covering the Middle East, actually from where you are now in England. So I was based in London for several years, covering and building out a presence on behalf of an asset manager in the Middle East. And then I studied Middle Eastern history, actually in London as well, at the School of Oriental and African Studies. So I'm always happy to be talking about it, but unfortunately, it always tends to be in these types of circumstances. And I always hate to say that we've seen this all before, but geopolitical risk in the Middle East has been a structural input into market volatility for many, many years. This one does feel a little different. And I think what's different about this particular event is how quickly information and disinformation is traveling. Public markets are responding, and how critical energy independence has become to national security strategies has become more pronounced than ever. I'm not going to predict where this all goes, but I would say, in terms of how I've seen and heard allocators talking about this, I'm hearing two common responses. The first is defensive repositioning or conviction doubling. And the truth, as you know, Ethan, very well, always lies in preparation. So for the venture side, it's a reminder that global conflict can disrupt supply chain, but it can also drive innovation, cybersecurity, logistics, infrastructure. But as I tell my students, history may not repeat, but it does tend to rhyme, especially in oil producing regions. So what I've been looking at more than anything are the drivers, staying alert to local dynamics as best as possible and not trying to overestimate your edge on timing of geopolitics. Unfortunately, right now, I think the uncertainty coming out of Washington, D.C. is also kind of creating this gamemanship, which is a little strange, I'm sure, for everybody who's tuning in. Will I announce? Won't I announce? Will the US be involved? Won't they be involved? I think it's already causing a rift here politically in the United States, particularly as it relates to the GOP's, which is the Republican Party's stance on how they are going to be approaching this particular conflict. But as I said before, it's hard to see again, but as it's playing out, I think it's just making sure that you're relying on trusted and reliable sources of information like this podcast.
Well, of course, and it's always been difficult to focus on markets when clearly these are the focuses of human tragedy as well. And I think you make an important point about the divisive effect on domestic politics, because I think what has been quite notable in this current cycle has been how was solid most of the entrenched bipartisanship has been, without much defection within that. And that has been perhaps the belief that there would be support for tariffs, there would be support for the big beautiful bill, and we may see some fractures appearing now, which will of course detract from some of the narratives we've seen. So we'll return to the Middle Eastern topic when we look again at oil. But thank you for those insights there. Just to get into some of our typical categories, just a quick note on inflation. We have had this sense that we're not necessarily getting relief when it comes to inflation. Literally, when looking at the UK, and we're seeing that the UK is back up again north of 3%. It was 3.5%, now it's 3.4%, still uncomfortably high. It wasn't just me that was thinking that chocolate seemed extraordinarily expensive. Chocolate prices are at their highest in over a year. So not even that relief from some of the stress eating that might be going on from looking around us. But we do know also from the Fed that the economy is kind of humming along, but barely. That the pace of job creation has been expressed to be a concern, and the Fed has been holding rates steady, sticking to its knitting, sticking to its guns about that. But also, I think in an interesting, and Robert, you are fascinated by psychology, I think, just like I am. We speak about that in our podcasts. The psychology of being vulnerable and admitting they don't know. I think that
Mhm,
was something that came out at the Fed meeting this week, and that seems to have not registered that much. To me, it was a remarkably brave position to take, and
mhm.
but equally, it doesn't put any certainty on what's already an uncertain picture. And this position was then taken, of course, in the face of some perhaps taunting and strong encouragement from the administration to cut rates. Any thoughts on the Fed's stance here? The fact that they're staying the course despite a lot of pressure?
Yeah, it's a great point, and I love that you use the word bravery because it feels like the Fed is the adult in the room right now. They're taking on this role as I guess you could call it a reluctant disciplinarian, and the markets are feeling it. So for allocators, this higher for longer scenario means that attention to short-term fixed income, private credit, rate sensitive equity strategies is probably going to be an area of focus. But I think it's, to me, what I'm seeing more than anything, and it's interesting, you also mentioned the job market, is that even though you may see some what feels like some optimism in the job market, if you look a little bit deeper, particularly at recent graduates, recent college graduates, I'm in a classroom, I'm seeing what's happening with at least our Drexel University graduates, and hiring has fallen off a cliff, particularly among entry level young adults who are entering the workforce for the first time. And it's compounded by the fact that prices are higher. It may be chocolate. It's probably not being as impacted with alcohol. They're not drinking as much, as you probably know from the statistics. But it's certainly something that is recalibrating expectations. And I think if you see something like a 5% cost of capital forcing, discipline across portfolios, it's starting to separate opportunistic capital from permanent capital. And it's created a different environment. So going back to the venture capital side, those who are raising money in a zero interest rate world are now adjusting to a new normal, where the burn matters more than the brand. And I think it's just going to beg a lot of questions that we're going to have to wait and see. But in terms of your original point, I think that's exactly what the Fed is doing. They are playing the role of this reluctant disciplinarian. They are trying to hold steady. They're trying to be the adult in the room. And so far, it's working. Will it continue to work is a different story. I won't make those bets on the podcast, but it has been quite interesting from my perspective to see it all play out.
And of course, they now have more in the tank, essentially, if they do need to stimulate the economy. And I'd say, interestingly, to see how recession expectations have moved around. In terms of the percentage that says a global recession is likely, we seem to be back in positive territory again now, and where we had really gone up as far as certainly up to close to 50% just as recently as April. It seems like maybe it's the summer feeling, but there seems to be a lot more robust attitude around the economy. Maybe the tariff expectations have receded, but I thought there was kind of an interesting data point around positivity there. And then we've talked about in the past this concept of Table Mountain and interest rates rising, staying kind of stable at the top. And we are really, despite having had this small dip, again, thinking about that shape of Table Mountain, just how long can the Fed maintain this stance and maintain this and this bravery that we spoke about before, perhaps in the face of other pressures. And I'd say what's interesting then, just to bring this back to a global perspective, is where we're seeing the rates being kept stable and the rates being cut. And right now, we are definitely seeing more rate cuts around the world. For those not watching the YouTube, on the left, we have a chart showing that the balance of rate hikes and cuts are definitely tending towards more net cuts. 14 more banks cutting than hiking in May. And we did just see the Bank of England pause today. That 3.4% inflation number clearly could not support a cut at this time, but they're holding and signaling that more cuts are likely. And then the interesting part is that the US, we've talked about US exceptionalism. It really is exceptional when it comes to where it's holding rates now. We can see that the rates are just being held stable when other areas are cutting. And I suppose then that this is interesting. Another phenomenon, and this perhaps gets back to psychology, is typically when we see a higher yielding currency, we would see demand for that currency. But this is going a complete inverse reaction and a relationship with the weaker dollar, that we are now in a position where the dollar is losing ground and against the euro, and whereas the euro rates have been falling and it is a lower yielding currency, but that doesn't seem to be affecting the demand for the dollar. And we'll speak about that a little bit later. But what's your take on this? I think in particular, and we have a slide later, Robert, around the weakness in demand for the dollar, because you probably have looked at this from many perspectives, but it really is a complex issue that's probably not uni-causal.
No, it's not. I think the way I've been at least speaking about it with our allocators, the guests that I've been speaking to, is they're thinking about currency as it relates to liquidity, return, and mission. So it's something that I believe that has become a feeling increasingly binary. So there's this nuanced approach, at least from portfolios, that asset allocators need to work harder. They need to be agile enough to respond to shocks and these types of events that are going on, particularly from a currency perspective, but patient enough to ride out the cycles. So that's pushing interest in these barbell strategies where you're pairing these ultra liquid core, mandates with these long dated private market exposures. So I think everybody is trying to reframe their definitions around diversification. That it's more than just currency, it's more than just asset class, it's return path, it's liquidity profile, and probably most important, it's operational complexity. So sometimes the biggest risk isn't the asset, like a currency, it's the misunderstanding of it, how it behaves under stress.
And we'll talk a bit about that later, just how this is forcing people like you speak with in your interviews to become more like currency managers. Whereas they can't
Exactly.
just manage the assets anymore, they have to have a very active awareness of the currency. And it's not as if they weren't preoccupied with the asset movements to start with. So again, more multitasking necessary on behalf of the active managers. And now just staying and keeping the lens back, we are seeing a bit of a summer of love make its way through Europe at the moment, certainly in terms of growth expectations, current conditions, ticking upwards. It's got the Eurozone ZEW index there showing the current expectations and conditions all looking better. And the business confidence is positive in Europe for the first
Mhm.
time in 3 years. And this is quite notable because it really has been, I'd say, at rock bottom in terms of confidence. We had the Draghi report, we had the suggestion that there was just a stranglehold of regulation, a lack of innovation, and essentially that Europe all of it was behaving like the sick man of the world. A little bit of reprieve with the German election, the release of the fiscal break, and really the relative attractiveness or stability in Europe compared to some of the unpredictability from U.S. markets. But I'd love to know whether you have a view on this Europe growth story that is starting to emerge, whether you have conviction in it.
Yeah, I mean, I think funny enough, I would assume there are a lot of Europeans who are watching the news out of the United States and saying, we're not really that bad, are we? I mean, things are actually pretty good over here. We're not really worried about a lot of the instability and uncertainty. There is uncertainty in European markets, but I think what you're seeing more than anything is people really taking advantage of an opportunity. It's a unique opportunity. European universities are actively courting, U.S. academics and researchers. European businesses are actively courting American executives to come over to the European markets, particularly in the face of a lot of challenges that are going on as a result of, again, uncertainty from the top down. So I think it's created this really interesting environment. I see it specifically within venture capital. You're seeing an increase, there's a lot of increased activity in early stage startups within the continental market, which has been very exciting to see. We see it ourselves at Drexel, reverse inquiries coming in from European universities trying to better understand how to develop an accelerator, within their programs, how to develop incubators, how to tap into an ecosystem to build out a true entrepreneurial framework within a city, within a region, and within a country. So I think there's a lot of optimism in some ways, despite a lot of the noise that's happening. And I think Europeans are taking advantage of it. So it's not a surprise in some ways, but it's I think what it's doing more than anything, and again, I always tend to take it back to the allocator, is that if there's been a couple trends in allocation as it relates to where people are actively either spending their time or trying to deploy assets, European equities has been one of those top spots. So it's interesting from an allocation perspective that they are finally, I'm sure the European equity managers are saying finally it's been 20 years, it's about time. But I think they're going to get a little bit of love over the next 12 to 24 months, as is the Japanese equity markets.
And I've got a chart on emerging markets coming up as well. But I think it's important also, a lot of our clients at Moneta would not be heavily exposed to non-US equities. And that's by
Mhm.
design, that they have US obligations and they've had a home country bias. And I think that this is not necessarily bad news for US multinationals either. Just recently saw a presentation about the Irish commercial property market, the high-end office market, which has a very low vacancy rate, around 3%, very strong opportunity set because of the many US tech firms that are taking huge campuses now within Dublin. That's going to be their non-US hub. They are able there to take advantage of a very well educated workforce. And this is
Mhm.
the engine of their growth just as much as a campus in Silicon Valley. So this Europe flourishing and seeing a creative and innovative ecosystem does not necessarily mean it's bad news for the Mag 7. This could be precisely something that the Mag 7 is taking advantage of. I think it is important, as you pointed out, to see where capital is moving to. And if capital is moving somewhere like Europe, it's important that it actually is put to productive use. And we spoke about just the sentiment. You said Japan has got some positive work. FX sentiment has been at its highest since 2021. It's still not as high as it was at the middle of last year, but just, as the dollar has been weaker, we're seeing a positive view on some emerging market currencies, which I think has been quite interesting. The other factor, you speak to allocators all the time, we are seeing bond yields quite tight. And that has been a driver of more demand for equities. So that has been a reason perhaps of fixed income looking a little expensive at this time. We know fixed income has been volatile. It's been challenging to be a buy and hold, not to be at least to be forced seller in the bond market today. Buy and hold is probably the better strategy. But because of these tight spreads, it's made equities look relatively more attractive. Um, and now we come to oil that we've cycled through some of the more standard. I'd love to revert now to this. What should we be expecting from oil? Is it behaving as you would have expected it, since it has gone on a bit of a roller coaster ride, up 9% since its low after there's been various messages coming out from the Trump administration around Iran?
Yes, I mean, this has been, I think a topic that I've been spending more time with than anything else, and I think what you're seeing to your point is that oil is essentially returned to being a political asset class. So its price is no longer just about supply and demand. I just said to somebody recently, it's about AAA. It's alignment, autonomy, and arbitrage. And for investors, that introduces this really challenging dilemma. How do you price this long-term transition risk alongside these short-term supply constraints? So in hedge fund land, I mean, that's an opportunity, right? But it's also volatility squared. In the classroom, it's a debate. Does oil's resurgence slow the transition to renewables, which is a topic I know you're quite passionate about when we think about things around environmental sustainability, or does it accelerate the innovation that we need in this particular area? And I think the truth is that both are true. Energy investing today isn't just about barrels. It's about bandwidth and how much risk, how much duration, how much moral conviction you want to carry, by investing in the market. But for now, it's gonna get us all motion sick because of all of the volatility happening in the markets. Particularly that geopolitical instability that we opened up our conversation with.
And the other thing, and this is actually maybe I'm committing a chart crime by showing a very short time frame here, which was really just over 3 days, and this is a longer time frame going back over 5 years of oil. And I think you did mention the motion sickness, and it certainly has been there. But the other
Hmm.
thing that causes sickness, and it's a kind of creeping sickness, is cognitive dissonance. So when
Hmm.
something is not behaving as you think it should. And I think there's a little bit of that happening with oil here, because you mentioned it has been very volatile, and we can see that over time, but it still
Hmm.
is not nearly close to its highs as it was at the time of the Ukraine invasion,
Hmm.
22. So it's not really as high as we think it should be. And maybe that's because of supply factors, and maybe it's deep down there's a concern about growth. And because of
Hmm.
the concern about growth, there's not likely to be a high demand for oil. We don't
Hmm.
really know, but I think that has been interesting. But what is also interesting, and this is what this chart shows again for the people not watching, is that how gold has been pricing in elevated risk consistently, but oil is not. Now, I would suggest that the risks that gold is pricing in are probably a lot more diverse than simply geopolitical risk. I think it's gold is pricing in this risk of fiscal going over the fiscal cliff, or a fiat currency being debased. So a lot
Hmm.
going on, but I think it is interesting just to compare that gold has gone one direction, oil has moved around a lot, but not ultimately been very high.
All that means is that my parents are going to start calling me and asking me if they should be investing in gold after watching Fox News. So I would I would warn all of your listeners that get ready for those calls.
Well, Fox News or Markets Happy Hour podcast, depending on where the wider audience is based. Um,
Exactly.
But I think the other remarkable thing is the lack of movement in the VIX. So we've had like
Hmm.
spikes in the VIX, but again, really nothing like what we saw post Liberation Day in early April. The VIX is
Mhm.
kind of moving on almost in a deadly calm, despite some of this. Increasingly, the headlines are dominated by the geopolitical environment. So it's very a little unsettling that we're not seeing more movement, perhaps in equities than we are until we don't, until things do spike. So that
Yeah.
has been the other quite interesting phenomenon. How do your allocators you speak with feel about this muted volatility? Has that ever come up in your conversations?
It hasn't. I mean, and, as you know, most of the allocators that I speak to are longer term in nature, so their time horizons, are a little bit longer term. If I were speaking, I think to equity managers and hedge funds on a more consistent basis, it would be coming up quite a bit. I think, to the chagrin, particularly of long short equity managers who were starting to get quite excited about the volatility that was being introduced into the market from the beginning of the year. This mutedness has caused, I think, some changes in their approach more recently. But the allocators, had set their agendas in many cases kind of in the middle of last year. They knew they were going to be doing work on Europe. They knew they were going to be doing work on Japan. Emerging markets was in the background. But those poor emerging market equity managers, it feels like they've been in the background for so long. It's just right on the outside of the work of an allocator right now. And then it's still being dominated by private markets. We're not going to talk too much about that today, just because there wasn't as much activity. But I suspect at some point in the next, several months, several weeks, you're going to have a market week recap just on what happened in private credit. But since it didn't happen this week, we can save that for another conversation.
Well, I am about to do a 50 Faces TV on what just happened in quant managers, which have been kind of
Hmm.
surprising, but again, small and not grabbing headlines, but surprisingly poor performance there. A few
Hmm.
more slides. Again, some of these from last week about the dollar weakness. And we're going to come to one of your favorite topics finally. Well, before we get to that, I'm repeating a slide from last week, which showed how gold is now the second most important reserve asset for central banks after the dollar, that the euro has actually slipped. There's more use of gold as a reserve asset than the euro, which I think is interesting. And we don't have to fear just yet about the US dollar not being a reserve asset. It still dominates clearly. And the last set of headlines is around AI. And I think sometimes that when we're so focused on the actual arms race, around actual arms, we forget about the essential arms race that's going on around AI, and we're seeing more activity, sort of almost unlimited deep pockets being raided here, and literal raids of other large players and sign-on offers, etc. Discussion of Meta trying to poach staff from OpenAI. And then the other point about the lobbying, the strength of this AI, whether it's around stablecoin, we've seen the stock Circle have quite the week on the back of the Genius spill. But also now looking for a ban on regulation by US states, suggesting that that would thwart industry innovation. But 10 years is a long time at the pace at which AI is developing to have a ban on regulation. So I just thought this was an interesting behind the scenes, just reminder of just how powerful these lobbies are becoming and just how quickly this is all moving. I know you have thoughts on this, Robert. We'll just close us out with a few of them.
Yes, I mean, I sit in a classroom, as you know, with 18 to 22-year-olds, and I have been there since, ChatGPT was first launched. So watching them integrate it into their lives so quickly, it was absolutely incredible. But what I saw more than anything was this, again, incredible improvement in expediency. So things were getting done at a record pace, but an equal drop in accuracy. And I think because of that gap between expediency and accuracy, I think we still have some time. There absolutely, I was thinking about as our conversation was going on, the old saying that the wars of today are fought over oil, the wars of tomorrow were fought over water. And now it seems like the wars of the future are going to be fought over AI. So everyone's trying to figure out how to participate, including students. And I think that the opportunity is clear. It's creating efficiency, it's creating scale, it is creating intelligence, but it is absolutely not creating wisdom. And it is absolutely concentrating power into, again, a few of these companies, which I think will beg other questions around deregulating and anti-monopoly laws that might be coming into place as a result. So I guess I would close it up not to test the audience, but certainly to test my students, is that to think, not just critically, but also creatively about how AI is going to impact investing. So as an advisor, and I talk to managers trying to integrate AI into their workflows without losing their own judgment. And I think that can be really challenging. It's the same challenge with students. As a podcast host, I'm sure just like you do as well, Ethan, it's in every conversation, how it's changing hiring, how it's changing research, how it's even changing manager due diligence. But I sleep well at night knowing that it is not going to replace investors. It's not going to replace people. It is going to complement them. It's going to speed things up. But I think one thing, as these arms races are happening, we're kind of all going to continue to do our day-to-day jobs. It's going to create some uncertainty in the job market, which I mentioned earlier in our conversation, particularly with entry-level jobs. It's not that they're being replaced by AI. It's just the company doesn't know whether it could be replaced by AI. So they're not hiring as a result. So it's just a lot of people sitting on the sidelines. And I think while people are sitting on the sidelines, you can give yourself kind of a crash course in how it can help your business, help your investment process, help the way that you digest information. But don't lose track of the fact that digesting information is very different than just throwing it down and eating too quickly. So yeah, I could talk about that all day, only because like I said, I saw it from the very beginning. Even the way that we teach has changed so demonstrably in the last 3 years. It's all about experience now. And I think that's what we're seeing. Even this podcast is experiential because people are going to need to feel like something tangible is coming out of what they're consuming. And misinformation is everywhere. And I think that's also going to be a big challenge. So luckily for us, you and this podcast exists and continue to educate us. I love everything that you do, Ethan. I really appreciate you inviting me today and with all humility, asking me my thoughts on macro. It's the one thing I don't do. I love to lifeguard, but I don't think and teach macroeconomics. So I appreciate you asking me my opinions.
Well, thank you, Robert. It's very kind words, and it's great that we ended up really where we started, which is around uncertainty. There's tremendous uncertainty around AI at the moment, and I think anyone will admit that even the higher echelons of court, the institutions we trust, the Fed, admit that they are in the dark, feeling in the dark to an extent around the economic direction. And I think that is the one thing we are all uncertain about some of these outcomes, but we are at least addressing them, analyzing them, and really looking at them from top to bottom. So, Robert, I'm going to suggest you get back to the beach, which is probably where you should be on Juneteenth, and keeping a few people safe there on the Jersey Shore. But thank you so much for coming here and for sharing your insights with us.
Thank you, Ethan, for having me. It's been an honor to join this podcast, and I look forward to continuing the conversation.
And thank you for listening and watching the Markets Happy Hour podcast. See you next week.